My name is Jeff Tate. I'm the Acting Director of the city's Planning and Development Department, and I welcome you to our presentation here, the Bank and Bankers Relationship 101. Today's program is being offered to the Auburn business community by the city's Economic Development and Planning Departments. This is in partnership with our Urban Center of Innovative Partnership Zone, IPZ number 15. Today's presenters have all been in banking for many years. They'll show us how important it is for you and your company to establish and develop a solid relationship with your banker. Mr. Rick Mickle is Senior Advisor and Principal for Bankers Capital Management, and will be heading up today's presentation. Thank you for attending. Rick has more than 42 years of experience in the Pacific Northwest and Arizona. He's a third-generation community banker with more than, as I said, 42 years of experience in the management and formation of community banks. He was a founding board member and CEO of two community banks that focused on lending, deposit, and investment services for the many communities that they served in the Pacific Northwest and Arizona. Mr. Mickle has had extensive experience in the loan, workout, and recovery industry during the recent economic downturn, including working as an asset manager and team leader for Huron Consulting, an FDIC-approved resolution assistance contractor, and as a special assets consultant for a medium-sized regional community bank. His successful engagements with these institutions has involved the entire spectrum of all types of commercial and residential use, real estate loans, as well as commercial and industrial loan relationships from a very wide variety of industry types. Mr. Mickle is a graduate from the University of Utah with a bachelor's in science in finance and economics, as well as an MBA from the University of Washington. He is also a graduate of the Pacific Coast Graduate School of Banking at the University of Washington. Thank you for attending. We hope that today's information is useful and helpful to your company in the near future. And with that, I'd like to welcome Mr. Mickle. Thank you.
Thank you. Good afternoon. Thanks for the warm welcome. Again, I'm Rick Mickle with Bankers Capital Management. Bankers Capital Management is a management consulting firm located in Redmond, Washington. And I have three of my other colleague principals in the audience today. Dave West is the founder and managing member of the institution, started the business. Ken Nelson is also a partner and principal, and Bob Rigg is also a partner and principal. And each of their resumes is at least as long, if not longer, than mine with respect to their careers in banking. So we do have a lot of gray hair, so to speak, a few scars on our back from all the time that we spend in financial institutions. As I said, we're a typical comprehensive management consulting firm, and one of the things that we find with our clients is probably a lot of misunderstandings and lack of comfort with their bank relationship. And so that's why we decided today to present this, and we hope that it will be of use to you. The first slide is the importance of bank and banker relationships. Well, first of all, it's communication. In our judgment, and what we see all the time, is a lack of early on communications between the business client, the principals of that business, and their bank, either their existing bank relationship or in search of a new bank relationship. And you know, the banker needs to become your advocate and to a certain degree your business partner in the business. And so developing an actual relationship with that banker is really, really important. Before you even launch the enterprise, if you have that opportunity, it ought to be one of the first things that you do in addition to all your market research or your product research or the competition research. You ought to be looking for a bank fit and a banker fit that fits you and your company and where you want to go. You know, potential lending requirements or other basic deposit or operational services, your need to know the banker and the bank banker's capabilities and the bank's appetite for certain products and services that you might be looking for, and their capacity and their makeup is really, really important. The other thing we find out very often is that new or early stage or startup businesses, or even businesses that are in a transition growth period of time, their financial reporting is not always the very best. And so what we mean by financial reporting, the content and the form and the frequency, is balance sheet and income statement and supporting schedules, projections and variances to the projections. Internally, we would recommend and suggest, in today's software world, you can get a lot of canned programs, QuickBooks or whatever, and there's some great programs out there that allow you and your staff and your business to have internal reporting that you ought to have at least on a monthly basis. And that could include, variances to your projections and tracking your business success. On an external basis, if you're working with a CPA, which you probably should be, there's lots of different formats that you could be in. Most people are in a compilation format, which is probably the most common and probably the most affordable for a young or startup or early stage business. But there's also reviewed financial statements or audited financial statements. And you may find when you go to work with your banker on a loan request or developing a relationship, they may dictate the type of financial reporting, both in terms of, reviewed or compilation or audited, and they may also dictate the frequency at which you might have it. But for your own purposes, internally, I think you should have it on a monthly basis. And we'll come back to projections in the business plan discussion in a minute, but those projections are really, really important, and they ought to have the ability to track to a variance month by month, quarter by quarter. It's really your roadmap to see where you've been, where you're going, where you can see the problems that you should be addressing, the opportunities to enhance certain things in your business will be very important. The next thing is, again, your banker should be, I think, viewed as a critical partnership. The partnership is really important in the good times, but it's absolutely critical during the tough times or the transitional times. If you don't have the kind of relationship with your banker that you can call up on the telephone or make the visit to the bank, or they can make a visit to your place of business, and you actually have an open, trusted relationship, it's not going to bode well during the difficult times. It's important to have during the good times, everybody's happy, you're doing well, the bank's happy with your relationship, but when things invariably take a turn for the more difficult, whether it's competitive things, whether it's the outside external environment that you can't do anything about, that's when you really need to have that kind of solid relationship with your banker. I would argue that choosing the right banker for your business is really kind of like choosing the right doctor for the right illness that you've got. It's just critical to the success and the growth opportunities and the way that your business is financed, to have the right banker. And what kind of a banker do you need? You need to have a fit, depending on the characteristics that your business has. You need to have a bank and a banker that has a level of experience, a level of authority, a level of internal influence, a personality. Needs to all be a fit with you, because during the tough times or the growth times, you're going to need to have a relationship where you can communicate, you're going to be on the same page, you know what their expectations are, you know what their capabilities are, you know what their turnaround time is, you know the types of products and services, the type of loan that they might be interested in or capable of, and you know what their capacity is. If you need $1 million loan and their internal lending limit or their appetite is materially below that, then obviously you may need to think about a banker switch. So knowing your bank's focus and its capabilities, whether it's consumer or business or real estate, and how they fit with you, and your business are absolutely critical. Yes.
Could you just expand briefly a little bit about, on the communication piece before you move on, about avoiding surprises early? If you see changes coming, good or bad, let them know ahead of time, don't wait, and hope things are going to get better. Again, it gets to the surprises are bad.
That's a really good question. Let me just repeat that again, is bankers are no different than parents. You know, when you're at home and you're a kid, parents don't like surprises. So the question really is about, essentially, in my paraphrasing what Ken has said, is, bankers don't like surprises. Things are going to happen in your business, again, some within your control, some beyond your control. You're not infallible. You're going to make a mistake. You're going to have a product problem, a competition problem. You're going to have a program problem and a finance problem from time to time, or a challenge. And the best course of action you can possibly take is be very proactive. When you see a material change within your business, be it adverse, it's easy to go in to your banker and talk about great things going on in your business. You beat all the financial goals, your sales goals are way ahead of gross profit, net profit, everything's sailing along great. But there are going to be times when you're going to have challenges. And it's frankly more important, and just as important, if not more important, to go in and visit with your banker and let them know right up front at the earliest possible discovery of a challenge or a problem. They're going to be a lot more empathetic and a lot more interested in working with you when they hear that, as opposed to 6 months later when they get the annual financial statement and all of a sudden there's this giant surprise that's a negative surprise in the profit and loss statement or the balance sheet. So they're just human. They're not interested in surprises. That open line and continuous line of communication, regardless of good times or bad, is really essential. So that's a really good question. That covers the first couple of slides, and so what I'm going to do is have my colleague Bob Rigg come up and speak to the bank products and services, and then I'll rejoin him to conclude on business plans and business and banking negotiations. So Bob, thank you.
Hi, I'm Bob Rigg, a principal with Bankers Capital Management. I, like Rick, also have about 40 years of banking experience in the greater Seattle area, so we're familiar with most of the banks, the services that they're looking at, the customer type that they're trying to attract. And when we work with our clients, we assist them with putting together a business plan, seeing what they need, checking out their financial statements, and we can line them up with banks that are looking for that exact product. Most of the banks are looking for a total relationship from the customer. They don't want to just have a loan with you or just have a checking account. They would prefer to provide your total banking relationships, and you can usually get a better deal on pricing if you keep your checking account with that bank and then you borrow with them and make sure that you keep them in the loop and let them know what's going on, just like the question that Ken had. When you go to your bank about 6 months later and tell them things aren't going wrong, they don't like that. They would rather talk to you 6 months in advance and help you out with the program. But my topic, bank products and services, includes deposits and operational services and loan underwriting standards, processes, approvals, benchmarks, and timing. Obviously, the deposit account is you deposit your money into the bank. They can do it automatically or whatever. They can have your other customers deposit to your account. But that's a very important service to the bank because the banks need your deposits to be lending out the money. And in the loan products, the two major loan product types are the business loan, which is commonly called a C&I loan, which is commercial and an industrial zone loan based on your business. If you're running a company that's a distribution business and you sell products and you have your customers are owing you money, and you want to expand, you need more working capital to buy more product, or you need to buy some equipment, you need to buy some more inventory, and so the loan products that the bank has would be generally a line of credit that would be secured by your accounts receivable, and as the accounts receivable paid you back, you would pay the loan back, or it could be loans secured by equipment. You might need to buy a new truck, new equipment for making your products or whatever, and or inventory. And so the banks can assist you in those needs. If you're a startup company, they might want to do an SBA loan because the SBA guarantees a portion of the loan, and it makes the bank more liberal in dealing with the startup business. If you're a well-established business, they would possibly take equipment or real estate for collateral, or if you wanted to buy your building, they would make a real estate loan on the building. And then the other category of loans would just be a general real estate loan, where they would provide a loan to buy the building or refinance the building, and that could either be on a long-term basis, or it could just be tied, secured to a letter of credit that you would just, it would be a revolving line of credit. Normally a revolving line of credit they want it to be paid off at a certain time. So you'd get access to $1 million, they would expect that $1 million to be paid off in a year or so. If it's a term loan on real estate, could be like a 5-year loan or a 10-year loan, where you just make monthly payments on the thing until it's paid off. And they have access to both SBA loans for general business loans and SBA 504 loans for real estate loans.
Bob, just maybe talk very briefly about the different underwriting standards or the appetite for loan types and sizes that vary between, say, a large national bank versus a community bank or a credit union. They tend to focus on different market segments.
Right. Well, the large bank.
Matching your needs with the appetite of the bank.
Right. Well, all of the banks now most of the banks now want to do deals. The recession's over. They need to make loans, and they're still a little conservative because they remember that they had to write off some loans not too long ago, but they want to do new business, even though it's a little more conservative. But the big banks like B of A, Wells, KeyBank, US Bank, they're going after the big, large commercial customers. They're very competitive, but they want the big deals. The regional banks like Banner Bank, Sterling Bank, Washington Federal, they're going after the middle market, small to middle-sized businesses, and they're actually easier to work with. They understand the customers, and they can really help you out. And then the smaller community banks, the ones that are left now, that have weathered the storm, are still very active, and they're probably the most liberal in assisting small businesses. Well, I think I've covered my topic, so it's up to Rick to carry on.
All right. Thanks, Bob. Okay, the next topic that we had put together was business plans at work. I mean, I recall back in the banking days when I was sitting on the banker's side of the desk, which we all did for so many years, is frankly, it's fairly infrequent and far too infrequent and far too unusual to have a business prospect lending client show up with an actual business plan. And I can tell you that business plans, are used, and I think very often misused as to what they really are. The business plan, from my perspective, it's really your roadmap. And if businesses take the time to sit down with an outside consultant, with other business colleagues, with competition, with their CPA and wherever not, and actually develop the various elements in a business plan and go through the exercise, the time and the effort to develop a business plan, and then not just have it sit on the shelf and collect dust and say that we did it, but actually become a document that's a living document that gets revisited all the time. It gets revised. It does become, in effect, your roadmap for your business. And it's one of the things that we at Bankers Capital Management do, and I know banks and bankers are interested in helping and can help work on business plans, revise business plans, modify business plans, evaluate business plans, and walking in to see your new banker that you're going to try and discuss your new business enterprise or your growing business enterprise or your business that's in a transition, to walk in addition to all your financial statements, and actually offer up a comprehensive, professionally put together business plan. Trust me, it's going to have a very beneficial impact upon that relationship between you and your banker. And it needs, like I said before, it needs to be constantly reviewed, updated, modified to fit what's going on in your business. Again, it's a living document. Don't leave it on the shelf. Revisit it.
Hey, Rick,
Yes, sir.
maybe just expand a little bit, if you could, on the sort of basic components of a business plan, projections, marketing support,
Sure.
things like that.
Yeah, that's a very good question, is maybe just discuss a little bit some of the general elements. And there's no set process for a business plan. It needs to fit your business, but there are obviously some consistent elements in most any business plan that you want to put together. I mean, you want to talk about the history of the company, if it does have a history. Maybe it's a brand new startup. You want to talk about the reasons for the startup. You want to talk about things like the competition. You want to talk about the general marketplace. If it's product-driven or service-driven, you need to have a very accurate and complete, comprehensive description of what the business is about. If it's in a manufacturing facility or a retail facility or a wholesale, you need to talk about the business as, you know, from kind of cradle to grave, so to speak. Or if it's in the service business, you know, the service that's being provided, why you believe that service or that product has got a viable nature to it going forward. The reason why the business is going to make sense. It needs to talk, the business plan needs to talk in detail about the financials in the business. You know, what the equity contribution has been, what requirements are going to be going forward, what the expectations are going to be with respect to income, the projections as the question mentioned, and the business plan needs to have a marketing plan, a management plan, discussing the characteristics of the management and the staff that is going to run the business, their capabilities, their past experience. So it just needs to really be a storybook, if you will, about the entire business evolution and the model, why it's going to be successful, why it makes sense, and it really tells the story and talks about benchmarks to measure that success going forward.
You usually want those benchmarks like every year or like every 6 months or?
That's a really good question. The question is about what frequency should the benchmarks have on them, and really the best answer is it depends. If you're in a brand new startup business in a very kind of semi-volatile industry or an industry that's changing a lot, or it's got a lot of characteristics of competition, then you probably need to be revisiting those benchmarks on a quarterly basis, at least, perhaps even monthly. Or if it's in another business where it's more stable and more mature, less competition, less volatility, outside influences don't really have too much of a big factor on it, then perhaps revisiting on a formalized basis once a year would be sufficient. So it really needs to kind of fit the characteristics of the business that you have and the characteristics of the industry in which your business is operating and competing.
That sort of takes you back then to the relationship with your banker. As you're updating that business plan, isn't that a basis for touching base with that banker as you're updating them, keeping them familiar with what's happening as things are changing? It sounds like that's a door opener, at least to me.
Right, I think it's an excellent question. Just to reiterate it, basically utilizing the business plan. Does it make sense to utilize the business plan as an opportunity, the revisitation of that business plan, the modification of that business plan, the update of that business plan? Is that a good segue and a good opportunity to visit with your banker? And I couldn't agree more. It's going to be impressive to your banker and your institution that you are monitoring your business in that context and at that frequency, and that you've taken the time to reduce that modification, that revisitation, that enhancement to your business plan, and communicating it to your finance partner, which your banker is. Your banker is your finance partner.
So I'm sensing then, okay, like a doctor, you want to be able to have a rapport with your doctor, the same with your banker. Now, I feel as though I have a good, somewhat of a relationship with my banker at Chase Bank. However, when it comes to like getting a loan for an institution of higher education, I don't think my banker, even though I might have a rapport with her, I don't think she will understand the objective or the mission statement or what I'm doing. Could I politely ask for a different banker?
Well, I think that's a perfect question. You talked about the rapport and the relationship with your banker, even though it might be respectful on both sides of the desk, and you're comfortable with it.
Yes.
But I think it's very, very important. What I derive from your question is that you need to be really comfortable if you're going to embark on a new enterprise. You're going to start this new education institution. Those are my words, to address a specific need that you'd like. It's very, very possible.
Somebody who understands
Sure.
education then, besides just,
Sure. And
and even though she's not as nice as my banker, the most important thing would be is that do they understand the field of education? That's the most important thing to me.
yeah, and I think that's very important that you search out, like I said early on in the discussion, you need to find a banker that has a personality, a background, an interest, and capabilities and authority that fits your business. You've got a unique business opportunity, and I think it's going to take some homework on your part. It's going to take some investigation on your part to connect with that right banker. I'm sure there's one out there. I'm sure there's going to be somebody out there that's going to be helpful to you. The last topic that we have is banking and banker negotiations. And I would suggest to you that everything within your relationship with your bank and banker, whether it's rates and fees, structure, term, amortization, collateral, personal or other entity guarantees, I'm going to tell you that should all be negotiable. Now, I'm not going to suggest to you that you're always going to get everything that you may desire, but I think that all should be out on the table in your investigation of the right banker to serve you. And as you have a bank relationship, hopefully your business is going to grow, it's going to prosper, it's going to become a better credit risk, it's going to be a more important customer. I mean, Bob talked about earlier about being a bank relationship. Bankers are very focused on having a bank relationship, and that means as much of a comprehensive relationship between deposit, operational, and credit services as they can get. And I think as your business grows, I think it's perfectly fine to sit down with your banker and have discussions about how your credit relationship, your deposit relationship, how it's priced. There's a large difference in interest rates, the amount of loan fees, not loan fees, the structure of the credit facility that you might have. It's important to have a banker that's interested not just in grabbing a product off the shelf and trying to kind of shoehorn you into that. You want to have a banker that's empathetic and interested in anticipating what your business's peculiar cash flow characteristics, income characteristics, growth characteristics might be, and designing a lending package or a loan product that fits your business. To a certain extent, each each of these lending products kind of needs to be, in my view, in the best case for small business, it needs to be customized. It needs to fit your business. Because the worst thing could happen is to sign up for a loan that is structured and put together in such a way that you know in your heart of hearts when you're thinking about it that the structure of that loan is not going to be easy for you to meet on a timely basis, on a regular basis. It's going to be a stretch. So I think those kind of candid conversations about the way that the banker might propose a loan that's got these various characteristics to it, I think is perfectly incumbent and important and appropriate for you to bring up and say, you know, that characteristic of your proposed loan package, you know, presents, I think, an unnecessary problem or concern or challenge for my business, and here's why. So in my view, all of that's negotiable. I think a lot of startup and early stage businesses aren't familiar with personal and otherwise guarantees. And I think you just need to understand in the environment that you're in an early stage business, a closely held business, anybody typically, as kind of a benchmark, anybody that's got 20% or more ownership within your company, say it's a little LLC, it's or a little subchapter S, it's a little C Corp, and you've got half a dozen shareholders, they could be family, in-laws, outlaws, whatever, within your small business. You know, the bank is going to be looking at your business, and it's very unlikely that you're going to have much of a balance sheet in terms of strength of equity ownership. You probably don't have a great deal of track record to go on. And so you're going to have to provide a personal financial statement, tax returns, and everybody else that is in that ownership position is going to have to provide. And it's very likely you're going to have to be asked to sign a personal guarantee to guarantee the business's performance. And in fact, it's entirely possible that outside collateral sources, perhaps even some kind of collateral interest in your personal residence or another piece of real estate that you might own, might be asked to be pledged to support that business obligation. That's kind of the price tag or the entry fee, if you will, for an early stage business, startup business, to get a financial loan package in today's world from a community bank, regional bank. So again, rates and terms, they're not forever. Your business is going to grow. Hopefully you're doing a great job with it. You're going to perform and do better through time. And it's perfectly fine based on your company's success, its liquidity, its increased net worth, its profitability. Go back and revisit, have a discussion with your banker. The worst that can happen is that they say no, and you feel that the justification for some change more favorable and those rates are there. You know, it's time maybe perhaps to go shop and have another discussion with someone else as a competitive banker replacement. So that's basically what I had to offer on this topic. We'd be happy to chat with any of you independently afterwards at any point in time. Bankers Capital Management, we have our website. It's part of the information that we've got here. It's bankerscapitalmanagement.com. It will describe in more detail some of the products and services that we have. We're a local company. We're local guys that have been around. We'd enjoy the opportunity to work with any of you. And hopefully some of what we talked today about bank and banker relationships, maybe it's of some value to you. So pick up the telephone, jump on the web, send us an email. We'd be happy to communicate with you at any time. Thanks very much for your time. Have a good day.
Thank you.